Alright guys, let's talk about what's happening with the US economy, the Federal Reserve, and why investors are starting to worry big time. Since 2008, the Fed hasn't been fully independent. Anyone paying attention can see that. Their main jobs are to keep employment strong and make sure inflation doesn't get out of control. The Fed has two main tools. First, interest rates. Raise rates, borrowing gets expensive, spending slows down, and inflation cools off. Lower rates, borrowing becomes cheaper, the economy gets a boost, and hopefully jobs grow. Second, printing money. They buy bonds to inject cash into the system, which encourages spending and borrowing and supports employment. But here's the tricky part. Recently, the Department of Justice served the Fed with subpoenas, which could lead to legal trouble for Chairman Powell. The bigger concern is US interest rates and Fed independence. If political pressure forces the Fed to act unnaturally, it could destabilize the entire economy. Investors, companies, and markets need predictable monetary policy. Mess with that, and confidence collapses. We've already seen warning signs. The US dollar is falling, gold is hitting record highs, and investors are looking for safe havens like Chinese stocks. If the Fed loses its independence or rates are manipulated, the dollar could fall further, bond yields could spike, and unemployment could rise. Right now, US payrolls are fragile. Only about 50,000 jobs are being added each month, unemployment is trending upward, and businesses are facing higher borrowing costs. Trump's recent pressure on credit card companies to lower interest rates could backfire. Risky borrowers may lose access to credit, companies will tighten lending, and tens of millions of people could be left without emergency funds. Currently, there's over $1.2 trillion in US credit card debt. The average household owes more than $7,000. If rates are capped at 10%, lenders will prioritize low-risk borrowers, leaving many vulnerable. Even short-term interest rates falling doesn't mean long-term rates will follow. Long-term rates could spike, destabilizing the bond market, weakening the dollar further, and making imports more expensive, which fuels inflation. Around the world, central banks are buying gold at record pace. In January 2024, gold was $2,000 an ounce and 40 tons were purchased. By November 2025, gold hit $4,200 and 45 tons were bought. The reason is clear. The dollar is losing value, not because of foreign countries, but due to internal US decisions. Financial independence of the Fed is critical. Once political interference starts, global markets react fast. Gold, silver, and other safe haven assets will continue to surge. Goldman Sachs predicts gold could hit $4,900 by the end of the year, and JP Morgan predicts $5,055. And these predictions were made before the DOJ subpoenas. With the current situation, gold could rise even faster and the dollar could slide more. The bottom line is the biggest threat to the US economy isn't foreign powers, it's internal mismanagement. The dollar could collapse, the bond market could become unstable, unemployment could rise, and inflation pressures could worsen. Investors should watch safe haven assets, review portfolios, and understand how Fed decisions affect their money. Let me know in the comments if you think the Fed can survive political pressure and how low you think the dollar could go. Stay safe and make sure to subscribe to stay updated as we navigate these crazy economic times.